Hi all, welcome back to our YouTube channel. Topic that we will have a look at today is from FRM Level 1 and topic is from FMP, Financial Markets and Product. It's from paper 3 and we will see it's from chapter using futures for hedging and topic is business risk. One of the most important topic from the exam point of view. And yeah, you will notice that we stimulate your thought process to enhance learning in one of the most like tricky topic, which is often misunderstood by the FRM candidates. So stay connected till the end of the day. As initially mentioned, it is most important from the exam standpoint. So this is a question that was asked in the one of the forums. So let's understand question. We will start it from the scratch. What is a basis risk and few tricks that will help you solving question in like 2.5 minutes very easily. So stay till the end of the video. 20 future contracts are used to hedge an exposure to the price of soya bean. So like 20 future contracts are hedged to expose perhaps there is some farmer who is who is expecting soybean crops in near future. So he has hedged 20, he has hedged that risk, price risk using 20 future contracts. Each future contract is of like say 5,000 bushels. So there is like contract size is 5,000. At the time hedge is closed, basis is 20 cents. So you are given that basis per bushel is 20 cents, kind of like dollar point two. What is the effect of basis on the hedger if the sell of soybean is being hedged? So you are asked if you are like short sell hedge, you are in a short sell hedge position. What is the impact of these 20 cent basis at the maturity when the contract is closed? So you are given that there would be gain like with some amount and there would be loss. So options are like not really that important, but we will understand first like what is basis risk and we will apply that concept in this question. And yeah, before we go ahead, please do subscribe to our channel, like, comment, and share with your friends as well. So let's understand, first of all, we will understand basis risk from this question from the perspective of short hedge. We highly encourage you to extend same concept for your long hedge perspective. Some bits are covered here, but yeah, in general, you need to understand long hedge as well. First of all, what we mean by short hedge, as I said, that say for example, farmer who already has like by default long position in soya bean or say corn bushels, any crop that he's expecting and which he wants to sell in near future. So he is afraid that price of that commodity that he is holding in a way may fall and he may end up selling at a lower price. So he what usually these kind of parties do, they go for short hedge wherein they sell asset they are holding in future. So they say for example this farmer will say that I will sell at say dollar five 6 months down the line. So price is pre-agreed and the timeline is pre-agreed. So in a way they are hedged with the price uncertainty. So there technically there are two components of short hedge. One is underlying position, which is actually held by the farmer of like say crop, and another one is future position, which he has actually created for hedging purpose. So there are two components to it. Like cash flows from these only will like give rise to base. Otherwise, see if you go to any book, the definition of basis is as simple as that, like spot minus future price. But like how these impacts your hedge or overall position, that is something which is I'm technically I'm like taking you to. So underlying position, say now 6 months have passed farmer is selling soya bean or corn bushels and he is getting, say, this price, the spot price at time t, say in maturity, he will receive that price. So kind of you are receiving that as an inflow to you. You will deliver that commodity and you will receive that money, say spot price at time t. Now, when it comes to future position, to hedge this risk, what he had actually done at t equal to 0, he had agreed to sell at the price f0. So that's why this f0 you will receive, because you had agreed to sell that commodity in future at price f0 at time t equal to 0 at the inception of the hedge. Now to close this future position, you, like you are selling, you need to buy. So where will you buy? Whatever is prevailing price at that time for that future contract. So you will pay for that, and you have already agreed to sell at some predetermined price, which is f0. So this is a cash flow to close this future position. So if I were to like summarize what total cash flows for short edge positions are, it is one ST that you will uh, get by selling, delivering actual commodity, and the F0 minus FT, which is actually closing out the future hedge position. Now, if I rearrange this, if I bring F0 at beginning, and if we keep this ST minus FT, this is actually basis as we initially suggested. So net receivables by short hedger position is F0, like future price that he has agreed to sell at, plus some basis. So if you notice now, like very important interpretation, this is a receivable by short position. So if this basis go up, because this is a receivable by the short hedger, if this variable goes up, it is favorable by short hedger. Of course, we have just summarized this matrix. How like short hedges. Basically, short hedger is receivable of the basis. That's why basis works in favor of the short hedger. And like analogically, it is a cost for a long hedger. That's why basis work against the long hedger. We have summarized this table, just but yeah, just remember this thing. Basis works in a favor of the short edge because it's a receivable, as we discussed above. Like it's a simple like two liner equations are giving like leading to this kind of a conclusion. So basis works in a favor of short edge, a very important point. Please make a note of it. Now let's understand a little bit more, like why. I'm making a statement. Of course, generically, it is making sense because we could rearrange terms, and from generic point of view, like it makes sense that basis works in favor of short hedges. But let's understand with an example, because examples are something which like gives you more insight and give you comfort that yeah, your concepts are in place. So let's say. On January 1st, there is some farmer who is actually, say, at that time, spot price of the wheat is $5, and he wants to sell that wheat at price of say 5.1. Now, I'm not going to detail of contango and backwardation. That's like not really required here. But yeah, these are like you can keep a your sensor on to observe the in which situation market is. That kind of stuff you should keep your mind on. So at the time t equal to 0, say January 1st, 2026, the basis is negative zero point 0.1. Now, see, basically, what technically what we are saying that after 6 months, say June 30th, 2026, if actually spot price of this wheat is 5.1, then there would be no basis risk. Like, or if you like if your prediction of the spot future like the spot price in future is correct, so there won't be a basis risk. So that would be a perfect hedge. Or like little trickier way to say it is like whatever is movement in the spot price, The same moment will happen in the future price. So your basis remains constant. So if there is no change in basis, of course the spot and future prices will move, but the difference between these two is constant. And if there is no change, you say that your hedge is perfect. When your hedge get distorted, when there are unexpected uncertainties in the basis, that's where you like the hedges lead to like get exposed to uh basis and it's practical. Like just imagine like say if the farmer is cropping like cropping wheat and suddenly there is a drought in that area. So what happens that in the spot market the demand of wheat goes up. So if the demand goes up, like the prices also will shoot up. So spot may go up like drastically. Like there won't be a linear movement in the future price. So these kind of stuff give rise to basis risk. So practically also like there is like you can relate it with the practical situations. So and the second like let's understand this basis strengthening. Now you have to make yourself familiar with these basis increases or basis strengthen. It's the same word. And like you can say basis widened or weakening. You can say like the weaken you can use the weakening, not really widening. You can use the weakening or strengthening. Those are the two terms those are used. Now let's look at this. In January, we saw that basis was minus zero point 0.1. And if the spot price drop, now be very careful. This is a short hedger. If like the price drops, like he would have like had he not used the future contract to hedge, he would have lost minus zero point 0.5 cents. But like the future price is dropping more. Like the future price dropped from 5.1 to 4.2. Like the and just think because if you look at this, if you see if it drops more, like FT is drop more because you have to purchase at that price. If it is dropping more, it's favorable for the short hedger. So if you see when he has to close the position, say for example, he has to close the position in February, he will purchase at a lower price as compared to this. Now he has to pay this price. So that's like so the short hedger would expect that spot price because the base what is basis it's spot minus future. So and what he would expect that this should drop more so that I don't have to pay much because he has to purchase at that price. So like the braces increased from minus zero point 0.1 to zero point 0.3. Like see, usually these comparisons are not required. In exam, you should keep focus on this. If this moves like say on a positive direction, then you say your bases have strengthening. And as we discussed earlier, strengthening of the basis works in favor of short edges. Let's look at the widening. Now, say in the cash market, he lost negative $1. Ideally, you would expect some gain from the like the from the future. But what is happening? Like the future price is like not dropping that much. Ideally, he would expect that if it has gone minus one, at least this future price also should go by minus one, like that kind of a perfect hedge. But it has like the spot price has dropped more, maybe say some sudden supply from some external player. The future price has not gone down. It's just a short term supply because of with the spot market has gone down. So the farmer is not able to cover that negative $1 loss from this future position. So you notice that I think there is some confusion, maybe copy pasting error. So over here, you notice that it has uh, it's 4 minus 4.9. So it's kind of minus zero point 0.9. It has weakening. See, what you need to do, you just have to see if you are moving on the negative territory, you say your basis has decreased. So if your basis have decreased for a short hedger, this basis has gone down and it is a receivable. So over here he will make a losses and it's intuitive because loss he had in a cash market was -1, but like the gain, technically it would be a gain for from the future. It's just minus point 0.2. So that's why when basis weakening happens, that leads to the losses for the short hedger. So if I were to summarize this, this is how your matrix will look like. Just remember this matrix. That above example was just for your basic understanding, like foundational understanding. Otherwise, like just remember this. If the basis not really, it just should be like the basic strengthening or basis increases, not really basis risk. Basis increases or basis strengthening, and basis decreases or basis weakening. If basis increases, it is a favorable for shortage, so he will make profits. And long hedgers, if the basis increases, he will make losses, because we saw that F0 plus basis. This is receivable for short hedge, and it is a cost for long hedge. So if the basis goes up, receivable increases for short hedger, so they will make profits. It this basis increases the cost of long hedge. That's why they make losses. And other way around, we can talk about. So basis is friend of short hedgers. Hence, like short hedger wants spot price to fall less than future price. Like basically, what short hedger will want, he will want that the future price should drop more as compared to spot price. And basis is enemy of the long hedges. Like works, basis strengthening works against long hedges. Hence, they want spot price to fall more than future price. They would expect that spot price should fall more instead of like the future price. Short hedgers will believe that future price should fall more, and the long hedger will believe that spot price should fall more than future price. So just remember this table. Trust me, most of the questions on the basis risk you will be able to solve if you remember this matrix. Very important matrix. So, like going back to our earlier question, it was a short hedge, and the basis had strengthening by zero point 0.2 cents, like 20 cents. Sorry, so it's zero point 0.2, and like the 20 future contracts were involved, and the one contract size is 5,000. So if you calculate this, it would be around, say this is 1 lakh, 20% of 1 lakh, so it's a net gain of 20,000 from this matrix, because the basis increased for short hedger, it would be a gain. And how much would be a gain? It's a 20,000. So this is how like the questions can be solved. You can explore in the same way if you were to explore for a long hedger. That's something which you can explore and put in the comment box if you have got any queries. And yeah, like reach out to our team if you think that these kind of recorded lectures would be useful to you. Reach out to our team, get your queries resolved. And yeah, like see, self-made is a myth. Like you can find videos on YouTube on this topic. You will see, like won't get any material. So take a proper guidance instead of like giving third time. Like this is not really recommended. Uh, the gap fees is on the one hand, but you are delaying your good career start. And yeah, like once you keep delaying your things, once you cross say after 30, like this curve will invert, and like you may have a less opportunities and responsibilities will go up. You're already late in career. Like it's not really making you afraid, but it's like just making you aware of the facts that you may come across. So see, it's on your perception, like how you perceive it. If someone is like making you aware of the facts and you perceive it as like uncertainty or other words, like, so avoid that. Like take it in a constructive way, plan it. Like if you think that you can do it on your own, absolutely fine. But yeah, taking guidance in the right direction is like something which is like highly recommended. Like you may see that these big people had some coach. So like it's not no harm in taking coaching if you think you can. Like no one is forcing you, of course. And yeah, thanks for watching and stay connected with the channel. And please do comment, share with your friends. And don't forget, please, to subscribe. Thank you very much for watching the video and connecting with the channel.